Good afternoon. My name is Valeria Piovesana. I'm a legal and strategic advisor to brands through their journey from set up the brand to exit. So what I focus primarily is how to add value to a brand in order to maximize the value when a brand house or private equity comes in and decide to offer you big money. The first thing I'm going to touch upon, and this goes from a legal and strategic point of view, is the structure of the company. Structure of the company means where I'm going to set up my company. That has different consideration. One can be from a tax standpoint. So you might consider to set up a company in a place that is convenient to you. Always consider them from a capital gains point of view. So means when you sell the company, you're going to pay tax where you're resident. So you don't want to set up a company in some weird countries, then you can't get out the capital. So you need to be practical about it. It's a small company at the beginning. Be practical, set it up where you're based. The shareholders. Now, if you're by yourself, is an easy step. You can control your equity. But if you're setting up a brand with some business partners, some friends, you need to have some principle agreed. It doesn't mean to have a 50-page shareholders agreement, but a couple of points, meaning I take care of marketing, you take care of sell. I do one thing, you do another thing. This is very important to have to avoid misunderstanding in the future. And the most important thing is to be aligned on exit. Earlier, Brian asked, what is the exit game for most of you? The majority of people want to maximize the exit, meaning in 3 to 7 years, make money selling to a brand house. So you need to be aligned with your partners. Your partners have to say, sure, we're going to sell in 5 years' time, and we want to have a multiple of 14. So that's your target. Then you adjust the target because the journey is not straightforward. But you need to be clear with each other about what your exit is. The other fundamental point that I always tend to advise my clients to do is to have a clear strategy on the IP. Because both investors and brand houses, they are doing a due diligence on your IP. What does it mean? You design, you have your brand name, your logo. You might design a custom bottle. You spend money on the mall. You spend money on an agency. All of these assets needs to be protected because they add value at the exit. They add value when, private equity decide to invest on you, and they also protect your brand and your asset. That's very important. In addition, so you have a trademark for logo and name. You have the design, and the design refers generally to the bottle of the cork. And the third point is the patent on the recipe, on the liquid. Regarding this, most of the brand houses don't consider this point necessarily. I think it's quite important because, first of all, you have an extra protection on the liquid, but also you can apply for what is called the patent box. The patent box allows you to have some tax incentive when you start getting revenues. So on income, you have some tax discount. That's very important. Third point, Giuseppe discussed this, is the P&L. You need to have control of your cost of goods. You need to know how much you spend. You can have a great plan on making a wonderful bottles, then it's all covered in gold, but then you got to sell it at the right price point. So cost of goods is very important. Marginality is very important because an investor and a brand house will look at marginality. You need to stay within the range Giuseppe discussed. You need to be around 60 and 70, ideally 70%. But you can start in the first 18 months of your life with a 50% margin. You might decide to, go a bit lower in order to then decrease the goods and exit at the right point. The 4 pillars of a good brand, as we said, is the liquid. You gotta get a good liquid. You gotta get a good packaging. You have to have a compelling story, because without a story, you're just another brand with another liquid. So you need to have a very strong story, and you have to be a good storyteller. Now, it's not that everyone is like Giuseppe, able to tell you a good story, but nowadays you can also have other tools to tell your stories. You can have brand ambassadors, you can have social media, you have various ways to tell your story. You just don't need necessarily to be a good storyteller. But those 4 pillars is what an investor and a house brand look when they look for a good brand. Positioning and pricing, again, within a portfolio, you need to find the right positioning. You need to hit the right category. You cannot just bring into the market a new brand, another gin, without having the right story for a gin. You need something different. And the position is very important, the category and also the pricing, because if you go outside the pricing that is established, it's very difficult to sell to the market. So if you go onto premium, you know what the parameters are. Super premium, you know the parameters are. Consumers, you know what they are. If you introduce a very expensive brand into the market and the category is not right, it's going to be very difficult for you to sell. So you're stuck with it. Distribution is a key to success, because at the end of the day, you can make an excellent product, but if you don't sell it, you're just gonna drink it yourself. So the reality is you need to distribute your product. You need to find a good distribution partner, somebody who gets you, because you're a small brand and the distribution houses, they're gonna push their own brands that are already performing. So you need to explain to them with your compelling story, then this is a good brand who's gonna make money, who's gonna generate revenues, and with that story, the distributor has to embrace your project. That's extremely important. If we go into distribution in markets which are the gold mines, like in the US, on top of that, you need a huge amount of money. To distribute in the US, you need capital. And this is another important thing to know, because you can still run a lower budget in Europe, but in the US, you need money for A&P. And brands needs to know that. Now, when to fundraise. If you have enough money to start the brand, getting the liquid in the bottle, get your IP ready, company, set up all the stuff, and maybe distribution in a couple of markets, then you have proved your concept. So you're at the point where you could go to investors. And in that, you have different type of investors. Brian explained very well the situation. In my view, if you have a smart investor, somebody who can add value to, so it becomes a partnership, somebody who can help you grow your business because it's well connected, because there is a value to what they're telling you. Go for that. Go for smart money. That money is good if they offer you $500,000 and they're happy just to say they're part of the project. You also take that. But the reality is, if you have connected money, is always better. How much and how quickly? Remember, fundraising is time consuming. So it's a long process. It's very ambitious and it's very tiring. So what you need to do is raise the right amount of money. If you need $1.5 million to enter the US, don't raise 500 and then thinking in 6 months' time, I'm going to raise more, because it's very difficult to raise more and you're going to engage new investors. It's very difficult, it's very lengthy, and you're probably not going to get the same valuation. So go for it, maybe lower your valuation, but get the money you need to fulfill your business plan. That's very important. At that point, possibly, you also want to set up a board of directors, somebody that gives you some governance at the company, so gives you also some advice. Get some good advisors on the board and can help you grow, and can help you, give you some ideas about how to expand. You cannot run a company, Brian said that, you can't be by yourself. You need a support structure around you. You need qualified experts who can help you within your growth. Now, in terms of exit, After you have raised money, you enter some markets, your revenues start to grow. Now is my 5 years down the line, 7 years, 3 years if you're lucky, whatever. It's time to consider what am I going to do with my brand. So it's always best if it's your decision to sell than getting somebody to approach you. But often brand houses are quite clever. So they come to you because they're realizing that you're in a good growth path. What are the multiples? I've seen multiples from 4 times revenues, which is the minimum, to 15, 17 times minimum. The maximums you get even to 20. It's a very, very aggressive valuation, but there are brands who can reach that. And, you know, my hope is always for brands to go to the highest amount. So we're talking about millions. So you need to have a solid business. You need to have a solid structure. You need to have a solid IP, solid company. Everything has to be in order to exit to a brand house or private equity, but mostly brand house at the maximum amount. Also very important to understand what does it mean exiting. Brian discussed this a little bit earlier. Exiting can mean to being bought 100% of the value of your company with an agreement perhaps to stay on for 1 or 2 years to run the company for the transitioning period. What I see now mostly are structured with earn-outs or call options, means they buy percentage of your company with an agreement to buy the rest when certain revenues are it, meaning you stay in, you generate the revenue, you still run the company as a CEO, and 2 years later, 3 years later, after a certain period of time, when you reach, 100,000 9-liter cases, 50,000, whatever it is, then they exercise the call option and they buy the rest of your equity, or an earn-out, meaning they buy everything, but there is a contractual arrangement that says, when I get to the point, then you reach certain volumes, you get a bonus. So that depends pretty much on the brand house is going to acquire you and also on the type of negotiation you want to have. But this is where you maximize your value. It's also important in way to maximize your value is knowing your customer, meaning get data from your customers, because that data will be transferred to the buyer. So know who you're selling to, trying to help the new buyer to achieve the maximum values, because you need to have a compelling argument on why you want a 14 times multiple in the valuation on your revenues. You need to understand if the new buyer will expand the market. So there is an analysis. If they buy you, is because they want to make even more money than what they're going to pay you for. So it needs to be an important decision for a buyer. Timing, I think, is best if you control timing rather than timing controls you. However, sometimes you also might be tired. You've been running this brand for 10 years and, you're like, okay, I'm done. I'm going to move to the next project. But ideally, when you're in the growth path, this is probably the best time to sell, because the objective is, other than with some exception, is to sell to a brand house for the highest multiple and taking home a lot of money. Thank you.